Are you ready for rate cuts? Well, Goldman Sachs has updated their forecast and now expects 3 consecutive rate cuts to finish out the year. If you want to keep track, you want to write down the dates. That is September 17th, October 29th, and December 10th. Yes, folks, to close out the year, Goldman Sachs is saying we will get a series of 25 basis point cuts. According to Goldman Sachs, the U.S. economy is at or very near stall speed and expects growth to be, frankly, a meager and below trend 1% in the second half. Fed President Daly out of San Francisco, time is nearing for rate cuts. We may need more than 2. Seems to agree with Goldman Sachs. See no indication of persistent tariff effect on inflation. Again, this is basically Fed Daily saying, Jerome Powell, you're worried about the boogeyman for no reason. The job market is weakening, and any further softening would be unwelcome. Folks, rate cuts are coming. And again, as I've said, I expect 50 by September, 50 basis points. July, I was willing to wait another cycle, but we can't wait forever. Again, that was Fed President Daly. We should be expecting a lot more Fed speakers over the next 7 days or so. It is becoming quite obvious, at least in my opinion, that the horrific revisions on Friday were not known. I think if they had had that data on Wednesday, they would have cut, and now they are just covering their backsides. Very, very interesting. We did get some economic data yesterday. U.S. factory orders fell 4.8% month on month. Although if you remove transportation, it was actually up better than expected at 0.4%. Daniel Zhao, chief economist of Glassdoor, says, we have finally entered the hurricane. And this is referring to labor, and we might be in the eye of the storm right now. We did get some earnings over the last 24 hours, and Palantir once again crushed it. If you're a Palantir investor, congratulations. You are up monster. You beat top line, bottom line, raised guidance, and actually hit $1 billion in revenue for the first time in the quarter. Congratulations. HIMS missed on revenue but beat on earnings. Revenue for the quarter was down quarter on quarter. That's the first quarter on quarter decline in company history. Simon Malls, this is again owner of Class A malls, Simon Group. They beat top line, bottom line, raised dividend, and raised guidance. For those of you thinking that the malls are gone and dead and buried, Simon says, hold my beer. Caterpillar beat top line but missed on earnings. Profit decline by higher tariffs and weaker pricing. Again, Cat is feeling it from tariffs. Eaton beat top line and bottom line, but said they expect over $1 billion, 1.3 to 1.5 in tariff costs. Lemonade beat top line and bottom line, had impressive growth. And finally, Marriott. Marriott beat top line, bottom line, actually added 17,000 rooms in the quarter, really on strong international demand. So shout out to the team at Marriott. I do want to congratulate 3 people who joined school yesterday, Ruth, Tom, and Nick. Thank you for joining school. We are quickly getting to 500 members. Remember, folks, when you join school and you're part of the first 500, we will be adding the Get Your Money Right course for free. We will put that in the classroom section. As soon as we hit 500, I think we're at 455 as of this morning. So only 45 more people join, and we will add some more goodies to the course. Hope you enjoy that. Tom Lee, once again, bullish. Tom Lee says we might see all-time highs in August. In August, which is interesting because if you watch the Dan Bird and I's weekly discussion, August and September are historically bad months for the stock market. But Tom Lee says, not this time. We're going higher and higher. I got an interesting post or a tweet from Matt, the mortgage guy, yesterday. Again, folks, if you have my number and you get some data you want to send my way, feel free. He highlighted that home equity as of today is $34 trillion. $34 trillion. So if you are a homeowner, You are part of that $34 trillion. That is actually twice as big as 2006. What does that mean? That means that when rates fall, not if, when rates fall, we are sitting on a lot of equity that can be extracted. Now, this could be extracted for lots of reasons. Could be debt consolidation, could be, whatever, could be investments, who knows? One thing is sure, that the equity is just building as rates are high. But as you know, rates are starting to come in. As we said earlier, Goldman Sachs says cuts are coming. Fed President Daly says we might need more than 2. So I don't know. We get rates in the 5s. I think a lot of people will not only think about moving or trading up, but many people will go to their house and extract some equity, which will just go into the economy as it usually does. Here's the one for you, folks. Rates have fallen. It wasn't too long ago that mortgage rates were 7.08%. As of yesterday, they were 6.57%. That may not sound like a lot. It's a half a point. But did you know, this is just math, folks. It's just math. If you were going to have a $3,000 mortgage, that drop in interest rates actually gave you $20,000 in purchasing power. That's how powerful lower rates are, right? A simple drop in 0.5% allows you to potentially buy up to $20K more house. I suggest in this buyer's market, you don't do that, but it just goes to show you that lower rates are meaningful. Again, from 7.08 to 6.57, so 51 basis points. If you assume a flat $3,000 mortgage, you now have an extra $20K of purchasing power. Let's talk about the accountability group inside school. This is just one of 8 different accountability groups. Feel free to join. Yesterday, they talked about build to rent, Gary, Indiana. They talked about the ORAT speaker lineup in Vegas. They talked about the Vegas housing market, Pittsburgh, and community banks with DSCR lending. Again, folks, join school, get around other people doing the work. You have 7 or 8 different accountability groups. We have some like Ladies of ORAT, Gen Z Plus, out of state, brokers, multifamily. They're all there. Find the one that fits your schedule, that fits your needs, and just introduce yourself. Also, folks, I want to hear from you. Anybody watching this already bought their tickets? Did you guys buy your tickets for our ORAT event? Again, we've announced headline Jason Hartman, Pace Morby. We've announced the agenda several different times. I hope to see you there. And again, let me know in the comments if you have bought your tickets already or if you plan to buy your tickets soon. So let me know in the comments below. David Kelly, a chief strategist at JP Morgan, out with a pretty negative headline yesterday. He says that the next 5 years, so that's till 2030, put that in perspective, there is going to be no growth in the workforce. Ouch. No growth in the workforce. Now, some of this is just baby boomers, migration, immigration, all of that. But it is very interesting to see. And finally, if you know about participation rate, that was the thing that irritated me yesterday, because if you assumed a constant participation rate, we would not be at 4.2% unemployment. We would be at 4.9. 4.9. And that is why I think big rates are coming. Looks like Jen and Kenny have gotten their tickets. So we will see them there. That's awesome. And just so you have a feeling, what's the difference? Because the participation rate fell. That's 1.2 million fewer workers. So the participation rate fell about 1%, a little bit less than 1%. That's not inconsequential in an economy the size of the U.S. That equates to 1.2 million fewer workers. So that is one of the reasons we are stuck at artificially low unemployment, is they are looking at a falling participation rate. So not good. And then finally, I read an interesting series of tweets from apparently an ex-JP Morgan trader, Ben Kelly. This is on X. I thought it was interesting, so I'd share it here. He said, these are the 7 wealth secrets of the top 1%. Again, this is according to Ben Kelly, ex-JP Morgan trader. based on his Twitter feed. Number one, assets over income. The wealthy, the top 1%, are looking to accumulate assets as opposed to just active income. Two, they learn to leverage OPM, other people's money. Number three, they go where the money is. If they are in a small town or whatnot, they go to a big city. Number four, they buy what's boring. They don't get surrounded by the hype. Number five, systems over hustle. It's not all about work, work, work. It's about adopting systems. Number six, multiple income streams. And finally, number seven, they buy from boomers. Yes, again, this is according to Ben Kelly, ex-JP Morgan. Chances of a rate cut in September have jumped to 90%. Yes, folks, as of this morning, it is 90%. Don't forget to go get our boy's book. I actually left my review yesterday. Dion McNeely's book here, Financial Freedom. It is no slouch at over 500 pages. Congrats, Dion. And we appreciate you. Also, obviously, use Steadily. If you are a landlord, you're getting crushed by insurance, you might as well look and see if there is a cheaper way. Steadily is getting a quote for me on another house right now. They're saving me money left, right, and center. So hopefully they can help you as well. Again, hope to see you in Vegas. Go buy your tickets and join school. Take care, folks. Talk to you tomorrow, 7:30. Later.